Thank you, Robin. So we want to welcome you all here today. The leadership team for SMS Corporate Strategy Interest Group really thought that it would be exciting to hear from David Teece from the Haas School of Business at the University of California, Berkeley, and Connie Helfat from Tuck School of Business at Dartmouth on the evolution of corporate strategy. So they are the first ones to lead us in this series of master classes for corporate strategy. And the way how we're going to run this session today is that we will have Connie and David each present. They're going to present for around 20 minutes. And then we will open it up for general Q&A. We would like this to be a really interactive, engaging discussion at the end. And so what we're going to do is we would like to ask you to use the raise hand function or the chat board for your questions. And we'll try to get to as many questions as possible with the time that we're allotted. So with that, I would like to hand it off to Connie to begin the session.
Okay, thanks, Katie, for the introduction. It's great to be here to see so many of these faces that I know. I have a few slides. You know, this master class, I wasn't entirely sure what to do. So I'm going to talk about a fairly narrow topic that I'm deeply interested in the hopes of getting more of you interested. And then I think David's going to broaden it out and really look at it, take a big lens on the question of corporate strategy. So I have some slides. I'm going to talk through them. And let me try and share my screen and see if you can actually see the slides. Okay, let's try this. Can you see my slides now?
Yes.
Okay, good, that worked. Great. Okay, so evolution of corporate strategy, a small, narrow topic. Let me, all right, hang on a minute. All right, a small, narrow topic. All right, so, you know, I interpret corporate strategy as a study of multi-business firms and the strategy behind it. This is a huge topic, right? Any company that's got more than one product, basically, qualifies as a study of corporate strategy. So products, horizontal and vertical, we're talking geographic markets, so that's all of international strategy. I think if you asked anyone, you know, what's corporate strategy, what's the one topic they think, what's the big topic? It's probably relatedness, right? On the resource side. Starting, I think the big study everyone knows is Remelt, right, in 1974, although there were a couple of studies before that. You know, I think probably the most comprehensive sort of analysis of what the literature has shown in terms of the performance benefits of relatedness is the study of Pallich, Cardinal, and Miller and SMJ in 2000. And they sort of said, look, the research seems to suggest there's a U-shaped curve here where up to a point, more and more relatedness improves performance. And then, you know, if you go too far away, I shouldn't say, you know, as you know, if you get too unrelated, then the benefits tail off. And, you know, that's, you know, people go back and forth and say, oh, the studies are mixed. And honestly, my view is, I think we know that up to a point, relatedness is associated with better performance than not, all else equal. I put in the caveat that David pointed out years ago. And I think I have the date is wrong there. It should be 1980, with the caveat that diversification only makes sense if the transaction costs of using markets are high, right? Otherwise, you should go ahead and use markets. So that's the baseline, right? So what do I think are the newer things that are happening? Well, one of the things I'm really quite fond of and that I want to talk about today is this idea of resource redeployment. Which I will define in a moment, but it's part of a bigger topic of asset and resource reconfiguration. We can think about Samina Karim's work on bringing, you know, reconfiguring business units, particularly in the face of divestitures and acquisitions. You know, David's work even talks about this, particularly his second big paper on dynamic capabilities in SMJ. And Samina and Laurence Capron did a nice virtual special issue on this topic in 2016. And the other big issue is, I think, ecosystems and platforms, where people are just starting to think about what does corporate strategy mean in this vein. I think a lot of the initial work there was all on multi-sided markets and how do we deal with this? And it's like, yeah, say hey, but there's some other things to think about. And I think David's going to touch on some of that. So I like to think about, well, you know, our usual view about relatedness, right? Just think about firms, not think about platforms or ecosystems, is we usually think about synergies, right? They've been formalized as economies of scope, where if you can share the asset, you can cost per unit go down, or, you know, demand per unit goes up, right? So, and it goes, you know, people tend to use the word synergies. So that's, I think, what most people think of when they think of the benefits of related diversification. So what is this thing, resource redeployment? So this is, resource redeployment refers to the partial or full removal of resources or capabilities from one business and deploying them in another business within the same firm, right? So it's partial or full exit from one business combined with entry or expansion of another business, right? And so the term that I coined for the benefits of this were the intertemporal economies of scope. So instead of sharing a resource or capability across two businesses contemporaneously, you can share them over time. And you still get the same benefit. Part of it is you don't bear the initial costs of developing the resources when you transfer them from one business to another. And essentially over time, you reduce cost per units, or equivalently, you can use the same resource to get greater demand over two businesses over time rather than at the same time. So they're basically economies of scope over time. Same idea that you need to consider the transaction cost of using market, same deal. You know, if you can get the resources you need in another business at equivalent cost rather than transferring them, then you should do that using the market. And I think Timo Sol and Tim Fulta have made that point. And I think that should say actually 2021 for the date. Okay, so this is a selective history of the research. Before my paper with Kathy Eisenhart in 2004, there were a couple papers that talked about, if you go look at Berger Wernerfeld's 1984 piece on the resource-based view, he actually mentions it briefly. You have to look hard, but it's there. The idea that you could redeploy resources rather than sharing them. There's a paper by Jay Anand and Harbir Singh, I think like in 1997 or something, where they looked at this in the context of the defense contractors redeploying assets to, you know, from a declining business to a new one. But I think, you know, Kathy and I wrote this paper, conceptual piece with a long example. Then Dan Leventhal and Brian Wu came along and said, oh, say, hey, we should think about the types of resources that are involved. Heather Berry talked about it in terms of divestment, right? Because when you think about redeploying assets, you're exiting one business partially or fully. And then Arkady Sarkatov and Tim Fulta wrote a couple of very nice theoretical pieces in SMJ relating it to real options. Tim and Samina and I did an advances in strategic management volume, which really was due to Tim pulling it all together and getting us on board, where we tried to look at more empirical and theoretical work. Marvin Lieberman and Tim and Gwen Lee have a really nice piece relating real options entry and exit in SMJ. And then Teresa Dickler and Tim Fulta very recently, and then Timo Sol and Tim Fulta have some empirical pieces. So I've left out some work, but I just wanted you to see the history. And I like to think research is accumulating, right? If you look at from the mid 2015 on, 2014 on, there's much more research. And it's a different way of thinking about diversification, right? So when we think about that, there are a couple things that happen. If you don't think about diversification and relatedness just as contemporaneous, you think, oh, well, okay, maybe we need to think differently. First of all, you know, there are costs of diversifying, right? And one thing about redeployment is, of course, the assets need to be fungible between the businesses, but the cost of transferring the resources are going to be a lot lower if they're related, right? Because they're going to more easily fit from one business to another. The other thing that I really feel is important here, and it doesn't have to be just resource redeployment, is the dynamics of diversification are really critical. I feel like, you know, in strategy, we're interested in growth, in progress, in, you know, how do firms survive and prosper? That's a dynamic question, not a static question. But all our theories are static, right? So the resource redeployment is one angle on trying to think about the dynamism. How do things change over time? And one thing is you might change, you know, where your resources are in the organization, right? So there are a couple of things when you think about these dynamics. Redeployment doesn't necessarily mean an increase in scope over time, right? You can transfer, take a resource out of one business into another. I mean, in theory, you could have a single business, you know, firm with multiple single businesses over time, right? People haven't looked at that very much, right? And the other thing is that exit is linked to entry here, right? In a way that it isn't always when people think about entry, for example, or divestment, right? Because exit doesn't necessarily mean you're getting rid of the resources and capabilities when you think about resource redeployment. So I think it's a somewhat different way of thinking about diversification. And I'll talk a little more, but I actually think there are a lot of examples out there once you start taking a new lens, right? But when we think about redeployment, I mean, one thing that Arkady and Tim did when they came along is they said, oh, which I never saw. I mean, you know, they're like, oh, these are like real options, right? When you start thinking about redeployment, resources, capabilities are real options, right? Because once you have them, you can start thinking about, well, if we don't know what the future holds, you know, but we could potentially adapt by redeploying our resources. This gives us flexibility. That's a real option. So you can think about redeploying your resources from declining business to growth business, which was what Kathy and I did when we looked at Omni Corporation. Teresa and Tim used CompStats data just to say, look, you can redeploy resources from a less attractive to a more attractive business. Assuming, you know, this has in the background that there are constraints on financing or managerial attention or something, which means you're not going to expand forever. And then Marvin and Gwen and Tim came along and said, hey, when you take this real options approach, you realize you have greater flexibility. It's not just that entry and exit are linked, but you can exit, enter, and re-enter a business if you have these resources. They give you this flexibility. And so again, the dynamics of diversification paths really open up a little bit. And then the last piece, I think, of this, thinking about this, is the contribution of Dan Leventhal and Brian Wu, where they came along and said, hey, maybe we should think about what they called scale-free versus non-scale-free resources, and what does this mean for redeployment versus synergies or sharing. And so they said, well, look, let's think about, they called them scale-free resources that don't have capacity constraints. In theory, they can be used, you know, as much as you like, right? So let's patent as an example, any kind of codified knowledge, right? But non-scale-free resources, by definition, are things that have capacity constraints. You can't expand them without limit. You know, individual persons only got so many waking hours in the day. You know, they only so much attention they can apply to one thing. So what they said is, look, these non-scale-free resources, you know, the things that are capacity constrained are more likely to be redeployed than scale-free resources, right? And that was their insight. I think that people in this literature have said, this means that only only non-scale-free resources are redeployed. And I think that's actually wrong, right? Because there are limits to that you may need to actually redeploy scale-free resources. I mean, you know, not just share them, right? Because some scale-free resources have to be used along with non-scale-free. So I put the example of patents. You usually need engineers to apply them, right? So, you know, they're not unlimited. So if you're going to transfer the engineers, you might need to transfer the patents with them, right? So if you want to use the knowledge that the engineers have of the patents, right? And then there are financial constraints, right? You may not be able to expand your business portfolio forever. And so you may need to transfer not just non-scale free, but scale free resources. There are some other wrinkles too, like you might actually, you know, you do share non-scale free resources. They are a basis for standard related diversification. So let me just say a couple things here in closing, right? First of all, you know, I haven't tried to do this now, and I'm happy to take questions, but I can give you tons of examples of companies, right, have done this, some of which are in the papers that I cited. But I think that, you know, no, this is a good lead in for David, but it's also a topic that all of you know is near and dear to my heart, which is that I think there are suggestions that you know, that there might be dynamic capabilities for redeployment. I mean, David and Margie Pederoff and Sovi sort of suggested that his idea of agility, you know, if you have a capability for this, well, redeployment would be a form of agility, right? Of enable you to adapt over time. So I think, you know, I'd love to see more work on, you know, dynamic capabilities for redeployment. We do, and they are clearly related to dynamic capabilities for resource reallocation, of which there's quite a bit of work. And I cited some of that below, if any of you are interested. Dan Lavallo and David and a couple co-authors have a really nice paper in SMJ on resource reallocation. It's a very nice working paper by Yasmin Kaur and her co-author Nicholas Lindelbauer, also looking at that. And then I am doing some work, let me just publicize my co-author Kathy Meriton, who's here. We're also taking a look at some of this in some work we're doing now. So with that, I'm going to stop and turn this over to David, I think.
Well, thank you, Connie. What a very rich presentation and one that has got me thinking already. In particular, this distinction between relatedness that relates to co-specialization and economies of scope and related or redeployment that is just based on putting the asset to better use on a standalone basis. These are very important distinctions, and I look forward to discussing that later on. But what I'd like to do now is stand back with a wider lens and look at the long-term evolution of strategic management and some of the things that are taking place in national and global economies, because I think in the end, these developments are incredibly important and will shape our research, or should I say, they must shape our research. So next slide, please. We have a set of developments that are unfolding every day now. Some have been unfolding for quite a while, but some of them I think do really require us to stop and think about what it is we need to do differently. First of all, the very nature of competition is changing. It's not just because of systemic competition from China. And by systemic, I mean the fact that the state and the private enterprise are locked at the kneecaps, or at the hip is perhaps a better way, whether they're public enterprises or whether they're private enterprises in China. The coordination between government and the private sector is very tight compared to what we're used to in the Western world. And the way we think about government and business is almost in separate categories, but that's not the way it is in China. And along with that is the increased salience of non-market strategies. There's been a rich literature on non-market strategies, but the political component of corporate strategy, I think, is increasing dramatically as we speak. And that's not just because the global order that we understood under the WTO and the rule of law is coming apart, It's not just because civilian and military technologies are morphing together. It's not just because of increased dispersion in the nature of knowledge. It's because the global innovation system is exactly that. It's not national anymore. Dick Nelson and others spent a lot of time in the 80s and 90s documenting national systems of innovation. But every national system of innovation is now embedded in a global system of innovation. And there's a kind of codependency there that didn't exist 20, 25 years ago. Along with that is increased speed of invitation, increased cyber attacks and IP theft. And then, of course, there's a rise of big tech and the rise of platforms. And the demise of the Washington Consensus. And if you read the news in the last week, activist shareholders are completely changing the agenda for what Shell and Exxon are going to need to focus on. It's no longer about shareholder wealth maximization. There are much broader social agendas that are getting injected into the boardroom. All of this matters. The question is, how does it matter for our mental models and strategic management? Next slide, please. This is a very high level and a very selective level, but the field of strategy got a big shot in the arm from Michael Porter's work on 5 forces, which was basically taking the received understanding of industrial economics as it had emerged from Harvard and Berkeley in the 50s and 60s, and converting it into a normative framework for how managers should think about creating monopolies or creating opportunities for extracting economic rents. That was obviously a landmark paradigm, as was Ramelt's work and Jay Bonney's and others on the resource-based theory of the firm, which you're all familiar with. And then, more recently, of course, dynamic capabilities, building on the resource base, but building a dynamic component, role of innovation and resource reallocation and things of that kind into the framework, making it maybe less operational, but at least more inclusive and more integrative. And that's kind of where we've been as a field in large measure. And the question is, where do we go now? Next slide, please. Well, let's reflect on what we think the fundamental questions are. There was a conference that Dan Schendel, Dick Ramelt, and I hosted in Napa Valley in the 80s, where we said there are 4 fundamental issues or 4 fundamental problems that the field of strategic management is kind of uniquely staked out for itself. One of them was, how do firms behave? Another was what explains firm level heterogeneity. Third one is the function of the headquarters unit, which is really what Connie was talking about in terms of resource redeployment and diversification and economies of scope and relatedness. All of those issues are embedded in 3. But the 4th one was what determines the success or failure in international competition. And for me, that still remains the big question is how do firms build competitive advantage, and what determines success and failure in a long-term evolutionary sense? That's fundamentally what the field of strategic management is trying. That's the question it uniquely owns. No one else seems to want to own it. It's too big and hairy for the economists to want to touch. So it's left to us in the field of strategic management. And I think there's been a lot of good progress on that. Next slide, please. So, just to summarize where at least I think the fundamental question is, it's how do managers build and sustain competitive advantage? And Connie has stated that, I think, in a more eloquent way, which is how do businesses achieve evolutionary fitness? So, you know, writ large, that is a fundamental question that, you know, drives interest in corporate strategy. But whether if you're in government, then it's obviously a public policy question too, because governments are interested in having businesses that grow and prosper and that can pay high wages. Investment analysts keenly interested in which firms are going to survive long term and what the performance of the business enterprise is going to be. So I'd say 60% of humanity wakes up thinking about this question in one way or another, how to build wealth, how to sustain corporate enterprise. And so what is it we really have to say? Next slide, please. Well, Porter's contribution was essentially around, well, there are attractive industries, and the idea is to pick an attractive industry and build barriers to entry and barriers to competition. While, of course, and to be fair to Porter, look over your shoulder for new entry, potential competition notion writ large. I've got also in there, Dick Nelson, the work that economists that are interested in institutions, and particularly the institutions that support innovation, I think is another very important building block. And you know, it brought continued and necessary focus on the role of supporting institutions, be it things like the National Institutes of Health that funds research and development in biotech, you know, whether it's DARPA, which supports a lot of frontier technologies, or whether it's work on basic research, which opens up technological opportunities down the road. So that's another building block. We have to understand, as strategic management scholars, we have to understand not just the firm, but the environment in which firms compete, and the role of government. You know, President Obama told us that we didn't really create, private enterprise didn't really create wealth, government did. And clearly, there are two sides to it. Without supporting infrastructure, private enterprise can't survive, whether that supporting infrastructure is the rule of law or whether it's institutional and financial support. So we have to understand both of those if we're really going to understand how companies compete, create value, and capture value. And then finally, you know, the dynamic capabilities framework, where, you know, I'll give Connie a lot of credit for helping to shape and refine my thinking in this area, and in particular, the key distinction between ordinary and dynamic capabilities, that, you know, building a great enterprise is not just about efficiency, it's also about efficacy. And that the pursuit of efficiency or ordinary capabilities can often stand in the way of longer term investments that actually create value for the future. So understanding those processes around sensing, seizing, and transforming. And we just heard an excellent exposition from Connie around what in the dynamic capabilities framework we think of as seizing or asset orchestration or the deployment of resources. But the deployment driven by an understanding of where the market opportunities are or where the threats are. So that's the idea behind that component of dynamic capabilities. Next slide, please. So here I'm trying to do something which few people seem to do in the field of strategic management, and that is pull all of these bits and pieces together. So I actually found a place for Michael Porter's framework on competitive rivalry, because we do have to understand rivalry in one way or another, whether, you know, it's within an industry, which I think is increasingly irrelevant, or whether it's in an ecosystem or between ecosystems, where I think it's increasingly relevant. That's what platform economics is all about. So let me just say that there is a place for understanding the basic rivalrous nature, but we have to reframe it away from industries and towards ecosystems. It's important to understand initial conditions, which is at the bottom there. you know, we can't just assume that cultures don't matter, that the price of factors of production don't matter. They clearly do. And in particular, with the rise of China and the decline of rule of law systems of governance, we have to take a tough look at initial conditions and how they're changing on a national and global basis. We also have to understand institutional and regulatory structures playing such a critical role. I mean, you can't understand the healthcare sector without understanding regulation and institutional structures. You can't understand any sector without really a deep knowledge of the institutional and regulatory nature. And we can no longer sort of compartmentalize that. It has to be an integral part of what we do in strategic management. And then, of course, there's firm level capabilities, whether ordinary or whether dynamic. So all of this has to be understood in a holistic way, I think, if we're going to bring wisdom. That's not to say that the study of the elements is not important. It clearly is. But the study of the elements without the study of how they all fit together is not a particularly useful purpose. Next slide, please. So where is it that we need to go? What is it that we need to get a better understanding of in the field of strategic management? All of these elements that I've just touched on are pretty well researched, which is a credit to the learning and research over the past, 30 or 40 years that the field has been able to support and generate. Where should we focus now? I think going back to my earlier slide, there was a link that I called link 4, which is the weakest link. And that's the link between institutions and governance arrangements and managerial choices. We kind of leave governance to the law school. There's very little work in strategic management on governance. Yes, we know that there's boards of directors, but there's really not much work in the field of strategic management on just how that affects managerial choices. There's certainly some work on it, but I think it's weak relative to where it needs to be. Economists like Bill Lazonick and others have pointed out that managerial behavior and decisions are impacted by the incentive structure and capital market pressures, and done an excellent job of showing how capital markets affect corporate strategy and corporate decision making. Some of the work I've done with Gary Pisano on appropriability regimes really links the legal framework and the regulatory framework through to corporate decisions and corporate strategies. But that's one of the few areas where there's an explicit link between the business environment and the legal structure around the strength of intellectual property protection, for instance, and corporate strategy. So all of this is simply to say that I think we need to double down in understanding these issues. Next slide, please. The other thing that I think is missing, not just from strategic management, but it's very much missing from economics too. Even though economists like to think that they have general equilibrium models, at the end of the day, they never pay any attention to them, or they're so abstract that they're pretty useless. And so everything gets to be done in a partial equilibrium sense. But if you go back to Adam Smith, arguably the world's first economist, one of his key warnings was beware of unintended consequences. And unintended consequences typically happen when you don't understand things at a systems level. And this is where I think dynamic capabilities can play a role, because it's a broad enough framework. It's what I think of as a meta theory or a meta framework that tries to pull together the various threads of what's now a rich set of ideas and concepts and knowledge in the field of strategic management. And I think that the business exec that has their mental models built just on 5 forces or just resources is headed for a nasty fall. And, I think of a number of execs that are starting to not look as smart. The Uber CEO is out not just because of the way he treated people, but there's a lot of misunderstanding about the broader environment in which Uber was going to compete. It's increasingly the case. Look at the surprise that Exxon executives got last week when shareholder activists managed to get 2 seats on the board and essentially changed the focus and purpose of Exxon, most likely, over the next 20, 30 years. So, and the big tech execs, getting pulled before Congress, in my mind, just like Bill Gates had a moment when he was in a deposition with David Boies, and that fundamentally changed his worldview. That there's a very slow awakening in the corporate suites of how important regulation and broader sets of societal issues are. And it's not just the growth of government. I think it's also that society has a different set of expectations, and that it's no longer just good enough to compete in traditional ways. So I'm not trying to say this is meritorious. I'm just simply saying that aspect of the business environment needs to be tied in some kind of explicit way to the work we do in strategic management. Just last Friday, Uber in the UK is suddenly unionized. And you wonder whether or not Uber could have taken a different strategy with respect to how you deal with how you disrupt. We all think that disruption's a great thing, and it is, and it's a necessary thing. But if you don't pay attention to who you're disrupting and what political influence they have, those that get disrupted will come back and upset whatever careful strategy one may have initially developed. In Europe, I'm struck by what seems to be the unstoppable march of the Digital Markets Act, which is going to dramatically regulate big tech, with very little work from economists or strategic management scholars, for that matter, informing these, radical pieces of legislation. So all of this is simply to say that I think, in addition to the traditional questions the field has engaged itself with, if it looks at the question of long-term evolutionary fitness, that necessarily takes you to think about the role of government, and the role of government, for good or for bad, is not diminishing. Certainly not in Europe, although it might in Britain now that it's free, and now it's because of Brexit it's possible, although unlikely, and certainly not in the United States. So explicit linkages to governmental decision making, I think, is something we need to pay more attention to. Next slide, please. So, here are just things I picked up from, last week's, newspapers. As I said, the big oil, tremendous surprise to CEOs. When CEOs get surprised, does that say that maybe strategic management scholars got surprised too, and that there wasn't research out there that was sufficiently robust to actually get these issues out ahead of the corporate world? So we'd like in the field of strategic management to be a leading indicator, not a lagging indicator. And I think we've largely been lagging indicators. We've been studying what's happened in the past, and we haven't really been able to contribute much in terms of what may come next. A recent article in the Wall Street Journal saying it's time to train AI risk managers. I don't know how much work there is in the field of strategic management on AI and risk management and the broader set of societal questions, but these are things we should be worrying about. And I'm sure some people are, but I'm not sure it's gotten the salience that it deserves. One more slide, and I think we're done. Next slide, please. Well, here is, no, actually just go back one. This is my effort. There's a paper I did called Fundamental Issues in Strategy, Time to Reassess, in the Strategic Management Review last year, where I've really tried to pull together, I suppose it's not just the various components of the field of strategic management, but perhaps also the field of global of international business. And I've never understood why international business or global business should be separate from a strategic management field anyway. But this is the world I think we're looking at, and we have to understand home country initial conditions. We got to understand, importantly, how China is changing the rules of the game, not just in global competition, but also in domestic competition. And I think the capabilities framework can be, a core part of that, but there's also plenty of room for bringing in and using traditional tools that we know about in the field of strategy. But if we've got this holistic view, I know it's awfully complicated and it's much easier to focus on elements, but some part of our time we need to think about how all of this pulls together or hangs together. Last slide, please. And this just shows that concepts from the field of strategic management are having an impact on the way people think about public policy. And Raina Kettle and Mariana Mazzucato in the UK are now beginning to talk about the dynamic capabilities of nation states and of governments, or at least the need to have dynamic capabilities. No better poster child than COVID. The bumbling way in which nation states around the world, in the main, not in every case, managed the COVID crisis. I think if you wanted to be a little bit more systematic about it, you can bring dynamic capabilities or at least the concepts of capabilities from the field of strategic management into the public sector. And I'm not aware of too many people in the field of strategic management are doing it, but I'm pleased to say that there are some folks who are public policy specialists and more interested in public policy that are beginning to do so. And I would certainly like to see strategic management informing a lot of the questions of public policy. Economics has had a very big role in that in the past, and many people would say that the market share that economists had is too great. I think there's certainly room for a single-digit market share from the field of strategic management, and I hope some of you folks will spend some of your time thinking about how to take the rich set of ideas, many of which Connie took you through a few moments ago, into the public sector, because that's where it's most needed.
Thank you, Connie. Thank you, David. So now what we're going to do is we're going to go ahead and open it up for a discussion and a Q&A session. So please use your raise hand function or the chat board, and we'll try to get to as many questions as possible. Let's kick it off with George Stalk. You had a question in the chat about ownership models. Would you like to elaborate on that?
Well, I'm just wondering, we talk about all the things that are affecting strategy, and we should be researching, but there's a big change in ownership models, and very little is being said about what are the strategic implications of that change. Short of private companies can do what they want without worrying about quarterly earnings. But beyond that, there's very little said. I was curious where that fits into these frameworks.
Yeah, George, let me take that. I'm not sure I understand the full import of what you're saying, but absolutely the ownership model, comes certainly in through looking at the international scene, where it's quite different from the United States. And, many of China's companies are publicly owned companies. But even when companies are not publicly owned, there is quite a bit of latitude in the way that boards of directors can take into account broader sets of societal questions. And also private equity is playing a very large role in ownership. And I think private equity in many ways is good for assisting in transitions and asset redeployments, because some of these redeployments that Connie was talking about are actually very messy. And to do them, in a public company context is more difficult than to do them, in a private equity dominated world. So yeah, I'd love to hear more about what you got in mind, but I do believe that ownership models need to be revisited continuously because of the changing nature of private equity and also the increasing role of China.
And of family businesses.
Yes, and family businesses too.
Okay, thank you. Please, like we said, use the raise hand function if you want to raise a question. Fan Jia, I see that you have a comment in the chat. Was this something that you wanted to elaborate on, or was this just a comment that you posted?
It's only a comment.
Okay, all right, thank you. Okay, so any other questions that you guys would like to raise? Johan. Johan, I think you're on mute. Would you like to ask?
Yes, is it better now?
Yes, that's better.
Okay, so first of all, I want to thank SMS for this very insightful organized event, and it's nice to listen to you, David. It's 3 years since we met back in Europe, and you actually promised to come back to Finland someday. So if you have that opportunity, I would be very, very interested to discuss with you this connection to government, which you brought up. And as you perhaps know, we have here in Europe, we have now a very active discussion going on, which is related to the question of the so-called New Green Deal. So how do you see that the issue of climate change, does it have a sort of an impact on how corporations will find a more uniform? Because it's very interesting to see now that Tesla, for example, has been applying for governmental or supranational funding from the European Union for its German factory. And it's rumored that they might give them about 1 billion euros for investing in Germany. So how do you see this game between large corporations and governments sort of on a global scale?
Yeah, well, with the dynamic capabilities framework, we always say that that companies shape markets as much as they are shaped by markets. And I think that these, global public goods questions, which is what climate change is about, to use the phraseology of the economists, are ones that are going to require a high level of cooperation, not just between nation states, but are going to require a change in mindset. And you see it in the two examples I gave last week of the shareholder activists surprising both Shell and Exxon by getting seats on the board. And they're going to change the private strategies of these companies towards more of a focus on alternative fuels. There's something different emerging here, Johan. I don't know exactly what it is. I think that my own view is a lot of these CEOs are a bit flat-footed, and managerial incentives have been focused way too much on the short term. I mean, by bringing in stock options and what have you, the incentive compensation that we've invented in the United States means that CEOs have gotten rewarded on the period in which they're the CEO rather than the period when they're no longer the CEO. But their tenure as a CEO has impact not only on the company's performance while they're there, but when they're not there. And I think that there's a backlash. I think our managerial incentives have been horribly short-term. And what's happening is governments are now forcing companies to focus on the long term. And they should have been focused on the long term, in which case they would have been, taking steps that are necessary for long-term evolutionary fitness without being poked and prodded by governments and by society. So that's my general take on the big picture here.
Just a short comment. As you perhaps know, one of these new board members of ExxonMobil is a lady from Finland, and she used to work for the Finnish government-owned oil company, Neste.
Okay. Well, I look forward to coming to Finland again and catching up on some of these issues.
Yes, please let me know. Thank you so much.
All right. Connie, was there anything that you wanted to add to that, or?
Actually, I thought these two board elections were really interesting because we've seen in the past these big funds have an influence on company policy, but it's been sort of isolated. I mean, CalPERS, which is a big pension fund for the state of California, has had a big influence on some of the strategic issues for some of the companies, but people haven't paid attention. And I think that, now where you see, funds like BlackRock and Vanguard putting activists on the board, that tells you there's something in the governance model that we're not paying attention to and we should be in strategy. I really do think that we kind of missed the ball there. I don't think that BlackRock is putting activists on the board because, because they're trying to, promote social justice, by itself. They actually think this is beneficial for the future of the companies. So I think we need to think more about governance.
Connie, you're on the money there, and because the activists are thinking about long-term shareholder wealth. They're not thinking necessarily about social issues, and what they're saying is management's not thinking about it, that ties up a lot with the poor managerial incentive structures that we have not said enough about. This is where the field of strategic management could have taken on greater responsibility to flag things which aren't consistent with long-term profit maximization. And we haven't. So I think there's an ethical dimension here that the field needs to think about in terms of our roles and responsibilities in educating managers and people that study management.
All right, some great points. Adrian?
Is it me?
Mm-hmm.
Yeah.
Yes. So I have a question for David. I think what you have shown in the PPT is about national governance structure to strategy. And you specifically mentioned multiple times about China. We all know that China was having a pan economy, so the government decided everything. And then they had open strategy, open economy policy. However, we all know that it's different from the free market policy of some Western countries. It's much more guided, it's much more constrained. It's not just for public companies, also for private companies.
That's right.
In the terms the government can control the loans, can put some structure inside of the company, etc. We know the Western theory suggests that if you have free market and everybody making rational choices for limited resources, then the overall efficiency should turn out to be the best. But if you put any constraint on this system, then the result will be only suboptimal. However, do you think right now the situation in China is actually more optimal? And if so, does that mean the free market theory has a limitation about the level of it? And does that mean that the corporate strategies need some national institutional governance or guidance? And if so, there are two issues. One is to which extent such guidance should be, and who should decide the direction of such guidance. And two, why such guidance will help. Is it because they help the managers make better choices, so the overall economy outcome would be better, or because they lower certain transaction costs of the multiple companies among many, many companies?
Wow, there's a lot of questions there. In terms of what I was saying in my slide presentation, I was only getting to the first point, that there are these significant differences and they need to be taken into account in our research. You're posing a second set of questions, which is, well, is this guided system better or worse? I think, you know, we don't know yet. I think in many ways, elements of it are quite positive. And, you know, in terms of getting companies focused on the longer term issues and unemployment issues, as well as, you know, the bottom line, I think there's some merit in that. On the other hand, you know, I've always been skeptical that government officials can actually, you know, ascertain the future. And I think what China has done quite successfully is that there's a lot of variety. Startups in China are possible, and there is so much energy and new venture that even if the government's trying to guide it, there's enough new enterprise formation that the economy is unlikely to stagnate. So I don't know the answers to your question. And I'm being more modest to say we should at least put the first order questions, namely, let's take into account there's a different kind of competition, call it guided competition, call it systemic competition. I think you're going to see in Europe and the United States greater coordination between firm strategies, because that is going to be necessary to compete with China. So the EU antitrust decision to strike down the merger between Siemens and, I forget the name, Alstom, was like blind to the nature of competition from China. And I think people are wising up and saying, look, yes, competition from China is different in nature and form, and we have to take it into account not only in private decisions, but in public policy.
But if like you have described, there will be coordinated strategy among US companies to compete with China, their cooperation or coordination would still be a result of free market choices, which is different from the China's way, which is more guidance from the above. So again, the question is, who decides it from above, and how do they do it? Making better choices, or they lower the cost?
These are deep questions related to technology policy and industrial policy that I'm more than happy to engage with you offline on these questions. I don't know most of the answer, but I got a few thoughts that I'm happy to share with you.
Okay, and Connie, I just wanted to open it up in case you have any last comments. I realize that we are at time. This hour went by incredibly fast. And so we want to thank you all for joining us here today, and thank Connie and David for coming and spending this time with us. So if we could all give a round of applause to Connie and David, thank you very much. If